Hello. Today we're talking about Repco Home Finance, and basically, I have this notebook where I have written down some information from the companies like con calls and all of that. So, yeah, today we're going to talk about the company's future. What are its future plans? What kind of loan amount they want to reach? What kind of profitability they want to reach? What kind of growth they want to achieve? So, they have talked about all of this in their con calls. Management has talked about all of this in the earnings conference call. So, let us start. So, by the end of fiscal year 2026, that is March 2026, they want to achieve a total assets under management of 16,200 crores. So total loans they have given out, they want to achieve around 16,200 crores figure. Currently, as of September 2025, they have achieved around 15,000 crores ish. Then, return on assets, they want this to be around 3%, 3.1%, and then the spread, they want the spread to be around 3.2%. What is spread? The spread is literally like the difference between the interest rates on the loans and interest rates on their borrowings. So if they borrow money from a bank, let's say around 3% interest, they want their spread to be 3.2%, so they will give out loans at around 6.2%. Understand? Yeah, it's simple stuff. Of course, loans are much higher interest rate, borrowings are at much higher interest rate than 3%. Then they want their gross non-performing assets, loans gone bad, to be below 2.5%. Below 2.5% by March 2026. Currently, it's higher. Then they want their net non-performing assets to be below 1%. Currently, it's more than 1%. This is good. Lower the gross non-performing assets, lower the net non-performing assets percentage, it's better. Then, this is important, this is good. By fiscal year 2028, we are currently around 2026. We are currently in fiscal year 2026, the third quarter. So by fiscal year 2028, they want to achieve an assets under management of 25,000 crores. This is a 19.9% CAGR growth in loan book. This is very fast compared to what they achieved earlier. So 25,000 crores, they're aiming for way faster growth than before. Then let us go to, yes, one more thing. The company wants to achieve consistent, consistent disbursements, that is loans actually given out, of 1,000 crores per quarter. So every quarter they want to consistently achieve 1,000 crores of loans actually given out. Loans actually given out are disbursements, while loans that are approved are sanctions. Loans sanctioned. So they want to achieve all of. In order to achieve this, they have said they're building up their sales vertical. That is, they're hiring more branch sales managers, they're hiring more direct selling agents. So they are building up their sales force. Yes. And for specific regions, they are making more specific sales heads in order to concentrate more on the regions. Then they're saying that they're fairly confident. The company is fairly confident of growing their loan book, that is total assets under management, by 20% year on year over the next 3 years. They're fairly confident. And I think, I'm not sure, but I think the latest quarter they did achieve 1,000 crores of quarterly like loan disbursement. I think so they did achieve it. But yeah, they're fairly confident. They want to go into this high growth era, which is nice. Now, 2 years ago, the loan average ticket size was 14 to 15 lakhs. And they're saying now it's around 21 lakhs. Is it? I'm not sure, but they're saying it. I hope I've written this correctly. Then, old Repco Home Finance and the new Repco Home Finance. So, they're saying that over the last 3 years, they have changed. That 3 years before, they were in a very bad situation in terms of many of the loans were going bad. The profitability was hit massively. And now, since last 3 years ago and onwards till now, they have sort of gone into this new era. So, old book, that is the old loans, and new book, that is the new loans. So new loan book is around the last 3 years. They have given around a total disbursements, that is loans given out of 9,000 crores. The new era loans around 9,000 crores, and the non-performing assets of this new loans are only 0.7%. So 9,000 crores, only 0.7% have currently shown up as non-performing assets, which is way better than earlier. Now, remember earlier we were talking about that by the end of fiscal year 2026, they want their gross NPAs, non-performing assets, to reach below 2.5%. Now they're expecting the fiscal year 2027, meaning even after 1 year after that, the gross non-performing assets to be below 2%. So right now, whatever it is, then go to 2.5% or below by March 2026, and by March 2027, reach below 2%, which is nice. That's really nice. Now, let's talk about their old book, their old loan book that had a lot of non-performing assets, meaning a lot of loans had gone bad. So, what happened and what did they do to improve this? Okay, so that's what the statement I've noted it down. Earlier, Repco Home Finance used to rely on only the profit and loss account and papers given to them by the customers. So earlier, the customers who could be, let's say, self-employed people, self-employed business persons who had their own businesses. So the businesses used to give them papers and like profit and loss account of the businesses. And they used that to evaluate kind of if they were credible for the loans. Now what they're doing, they've introduced a lot of income assessment models and they're inspecting the customers' business units, assess their incomes. I think there are more points, but I've only written this down. I'm a bit lazy. I'm very lazy actually. So I guess as a summary point, what they have done is that earlier they used to look at some metrics to assess a customer's credibility, customer's future income, current income, can they pay back the loans, how good they're for the loans. There were certain number of metrics introduced. Now they've introduced even more models. They're doing even more stuff in order to assess the credibility of a customer so that to see if they're credible. And I guess if they're introducing more and more metrics, they're able to assess a customer's credibility better. They're able to understand better than before if the customer can pay back or not. That is what the company is saying. Then, is there any more thing? Yes, this is important. This is good. This is good. So, company had earlier given guidance of adding around 40 branches, 40 physical bank branches, but they only added around 24. What was the reason? The reason was that the company is moving towards channel wise growth rather than physical branches, and they're making channel wise teams. So remember this. So earlier they were focusing a lot on branches, like a physical bank branch, but that had a lot of costs. People had to be hired, and building, furniture, and computers, and all of that had to be bought. Now they're going into channel wise teams, that is, specialized teams, group of people they created that would actually go to businesses, that will go to builders, go to potential clients, go to potential customers, go to them and offer your services to them. Yeah, so earlier, yeah, that's what they're doing. They're saying this is a more agile and cost effective method that now they're not having physical branches. They may not rely on more and more physical branches to actually increase their sales. Now they may rely more and more on these specialized teams that will go to customers, go to potential customers, go to more and more people, offer services, talk with them, and offer the financial solutions, that is, loans and all of that. And I think the one final thing we can talk about is balance transfer. Now, what is balance transfer? Balance transfer is, from what I understand, I think I've forgotten the meaning, is that when a customer has taken a loan, but they are changing the loan to another bank's loan, which the other bank is giving at a lower interest rate. So balance transfer, they're going from one loan to another at a lower interest rate, it will benefit them. So this is the problem faced by financial institutions. They've given out loans, but the customer is not taking out other loans from other financial institutions at a lower interest rate to replace their loan. That's a problem, right? More balance transfer, the loans are coming back. You're not able to get the interest for a longer period of time. So, how's the company dealing with balance transfer? Various initiatives have been taken, and now the result was that in fiscal year 2023 and 2024, the balance transfer out of the company loans that more loan the customers are going towards other loans, lower interest loans than balance transfer in. So balance transfer out, you're not benefiting from balance transfer. Balance transfer in, you're benefiting. Customers from other banks, they're coming to you to take loans at a lower interest. So balance transfer out, balance transfer in. In fiscal year 2023 and 2024, balance transfer out was more than balance transfer in, but they took various initiatives, and now fiscal year 2025, balance transfer in was more than balance transfer out. That's good. And one more thing written here is that normalized credit cost is now normalized in fiscal year 2026 and fiscal year 2027. So credit cost is now going to be normalized. That's an important expense. Now let me just see if I got this definition of balance transfer correct. What is balance transfer? So Google says balance transfer is moving debt, personal loans or credit card balances from one account to another, often using a new card or lender to get a lower interest rate. Yes, yes, yes. Yeah. You apply for a loan, then you apply for the loan to pay off the original loan, but the new loan you have taken is at a lower interest rate. So yeah, balance transfer. So they have done initiatives, and that's going to, what do you say? I'm losing my mind. Yes. Now the balance transfer in is more than balance transfer out. So in fiscal year 2025, they were able to solve the balance transfer issue. I think that is it. Yeah. Repco Home Finance is looking at some good growth, expecting good growth. Let us see if they can achieve that growth in the future. That is it. Bye.